Hello and welcome everyone. Today we are joined by Alan Carter, President and CEO of Cabral Gold. We've got Kevin Bullock, President and CEO of Anaconda Mining, and also Danny Callow, President and CEO of African Gold Group. These are three guys that I enjoy talking to and listening to. And today we're going to try and make sense of what's going on in the market. Some extreme reactions, certainly with gold, copper, nickel everywhere. Before we do though, guys, can you just each introduce yourself? I'm going to start with you, Kevin, and then maybe Alan, and then Danny.
Thanks very much, Matt. Kevin Bullock. I'm President and CEO of Anaconda Mining. I'm a mining engineer, started out as an underground miner and worked my way up to getting a degree and then working in operations. And I've been a CEO for the last 25 years. And Anaconda is busy in Eastern Canada, in Newfoundland and Nova Scotia, with its development project being the largest gold deposit in the province of Nova Scotia.
Yeah, thanks, Matt. My name's Alan Carter. I'm the President and CEO of Cabral Gold. We have an advanced exploration project in Brazil. We currently have two gold deposits, which are about 5 kilometers apart. You have 5 rigs turning. We've made 5 new discoveries in the last 18 months. So we're very busy and a lot of drill news coming over the next few months.
Thanks. And just to add another continent to the mix, my name is Danny Callow. I'm the President and CEO of African Gold Group. We're TSXV listed, and we're focused in West Africa, in Mali. We have a very exciting project on the go. We've spent the last 2 years drilling and developing it to a definitive feasibility study level, and we're really in the position now to be able to develop, construct, and build this. And like Kevin, I'm a mining engineer by background, and worked my way up through underground mining to running mines for a number of diversified miners.
Guys, thank you very much for joining us. I hadn't realized how clever we were. We've got North America, South America, and Africa all represented today. Well done, the editing team, for that one. Guys, the gold has just gone over 2,000 today, hit $2,050 today. Is this the beginning? Is it gold 3,000 finally? Start with you, Kevin.
Well, I always like to think that we need to make our projects work at various prices of gold. We need to show the upside to people, but we also need to show the robustness of any project. So the way we went through our feasibility is with that in mind. We were quite conservative. We have a definitive feasibility now for 100,000 ounces a year for 11 years from our open pit in Nova Scotia, which has total resources of 3.1 million ounces. And it really is, when built, a license to print money at these types of values or higher values of gold. But reality is it's very, very robust, even at $1,300 US gold. So the robustness of the project is important to us. The infrastructure that's around it and the type of area that it's in for ease of permitting and for being able to work in a safe environment. So yes, I think gold's going to be up and hit some peaks here and there, but over time, we have to make our project work at various prices. I want to get into the more kind of macro component here, Kevin, if you don't mind. So it's broken through 2,000. There are lots. I suspect we'll see the same people who kind of came out last time it got to 2,000 or near 2,000 get a little bit excited. We'll see those crazy headlines again. And what I'm trying to understand is how real are statements like gold 3,000? I know they don't need to be there because you're making lots of money at these sorts of levels, but the geopolitical state of the market is very, very interesting, exacerbated by what's going on, obviously, in Ukraine with the Russian invasion. Gold did not react all of last year. 2021, the expectation was gold would move. It didn't. Why now? Well, gold's a safety net. Gold's a hedge against inflation. Gold is a form of currency. I truly believe, and always will be, and always has been. And when the world is in such peril like it is now, following COVID and having not only the war in Ukraine, but wars around the world, and tensions building up, what happens is you go to a safe haven, and there's various safe havens out there, and one of them is definitely gold. That only has a small investment community. So a little bit of an increase in that community, taking advantage of securing their wealth with physical gold, really makes a difference in the price. So I would say that I wouldn't be surprised if gold hit 3,000 at some point, but I don't see it staying there. I see over time, unless costs, the escalation in costs that we have stay escalated, what I'm hoping for is a rollover at some point in the future, by the time we build our project, that the gold price has moved to a point that's quite attractive, like even now. But the actual costs have rolled over, because quite honestly, if we have 25% inflation like we're seeing in some feasibilities following pre-feases and PEAs, if that continues year over year, all the mines are going to close down unless the gold price stays up. So something has to happen. Either gold has to come back a bit with costs, or it has to keep moving up with costs. So, that's, I can see some crazy numbers, but I can't see them being sustained for long periods of time. I think overall gold's going to continue to rise in a linear regression rise from years ago, but there will be peaks and troughs, and it will be highly volatile in this environment.
Alan, you had a spectacular year in 2020, up 10 times. 2021, flatlined. We had discussions about people being distracted by Bitcoin, by cryptocurrency, by tech. They just weren't coming into gold in the way that the entire market expected them to. Did things just get a little bit more real?
Yeah, I think they did, Matt. I mean, look, we're in a completely different environment now. This isn't just an isolated geopolitical crisis. This is going to impact everybody on this planet. Why? Because both Russia and Ukraine are such massive producers of everything we use. Everything is going up, right? Petrol in your car, the price of a bottle of wine, the cost of a pint of milk. I mean, everything is going up. Inflation, and as a result, inflation is going to move up big time. Commodities are all going to be in short supply. Supply chains are going to get under pressure. The bicycle you wanted to order that had a 4-week lead time is now going to take 6 months if you're lucky. Everything's going to change. And this thing is going to be protracted. This is going to go on for months and years. So strap in. So I think I disagree somewhat with Kevin. I think, yes, 3,000 gold is quite achievable by the end of the year. Maybe it's not 3,000, but it's going up, and it's going to continue going up here for medium term, in my view.
That's okay. Okay, Danny, let's get you into the conversation, then we can riff off of each other. Danny, has there been a reaction yet with the juniors? You're one of those sort of smaller members of the team here in terms of market cap. What's your expectation of what this is going to do for you?
Yeah, I don't think we've seen any real reaction for us that are not in the production side, because clearly we're not making any profits or margins. I think we will see some if we see a sustainable increase in gold, which I think will happen. I don't think it's going to stay around 2,000. I think it's going to move up. But I think just exactly what Kevin and Alan have said, the costs are going crazy here. I mean, before this invasion, we were talking about double-digit inflation. I don't know what that's going to be when it works itself out of this. But if you're talking 130 oil now, and probably if some of the sanctions that are happen, then you're talking $200 oil. That has a knock-on effect across every single operation. And I think we saw it in from 2020 to 2021. We delivered two definitive studies, very similar, just with bigger resources. And we saw about a 12 to 15% real increase in all-in sustaining cost in a year. And that was mainly driven by oil. It was driven by inflation. It was driven by steel prices. And I think that we haven't seen anything yet. So I think I do agree with Kevin in the sense that it's all well and good having 2,500, 3,000 gold, but if the costs are going up at an exponential rate, then you're still going to see a lot of panic in this industry where you're not going to see the margins that everybody thinks you're going to see at 2,500, 3,000 gold. So I'm a much bigger proponent of a much more sustainable improvement in the fundamentals of gold, and that's with central bank buying again and a lot more stability in the market. I think that will give investors hope, because remember, I mean, I'm not sure where Kevin and Alan are in the progress of, but it sounds like we're all in a similar boat where we haven't started construction yet. You've got 18 months, 2 years before you start getting gold out. So we need a sort of a sense of stability to know that when you put money into this company, we're going to deliver gold at very good margins. And when it's as fluctuating as wildly as it is now, And, we talked about it earlier. When you've got diversified miners, one of the big 3 or 4 mines fluctuating at 6 to 8% over the course of a day, up and down, it just means that there's chaos in these markets. That doesn't necessarily really sort of translate down well for a junior miner, in my opinion.
I have to say, I tend to agree with you, Danny, on that one. What we saw in 2020 were marginal projects getting financed. Money was being thrown around on perhaps projects which, didn't have strong fundamentals or, quite frankly, even a good asset, but the money flowed. And that's fine. There's momentum investing. That's fine. There's fundamental investing. In my mind, that's better. And price solves a lot of problems sometimes too. So as gold appreciates, do you think we'll see a repeat of what we saw in 2020, Kevin?
Yeah, I think that, in a lot of cases when gold is booming like it is and is about to even more, I think what you'll see is some projects get funded that shouldn't be funded. I haven't done an evaluation of projects, but with our own, we're the highest grade undeveloped open pit resource on the east coast of Canada. We're the largest gold project in Nova Scotia. As a matter of fact, we announced that we are the largest private investment in the province, which was quite a surprise to me. So, we have approximately 18 months to 2 years to finalize getting all of our permits required, and then a 2-year build. So we're not producing for 4 years. What's going to happen in those 4 years? I have no idea. However, if you look at a gold chart, you have peaks and troughs and an inclining curve over time. And what we want to do is we're looking at our business as a business, not as a gold mine producing gold. We want to produce cash flow. We want to produce margin. So there's always a trade-off between cost and revenue, and that sometimes lags by a year or two. In other words, if you do a feasibility today and you build 2 years from now and things don't change, your cost is going to be up 30%, 40%. But there's got to be a rollover at some point where you do a feasibility at a high point, and then when you build it, people say, wow, you were really good. You did it for 5% cheaper than you said you would. Well, that's because the gold price is also coming down and the margins are basically staying the same. So what we like to do is talk about grade, because gold and the price of producing it kind of flow maybe a couple of years apart at most, but flow kind of together. And, if we've got one of the highest grade and a great margin, at these prices and at lower prices and at higher prices, that's what we're interested in, because we're not mining for a year or two. We're mining for 18 years. Yeah,
I think that's important. So it's kind of helpful for investors to kind of, have an honest conversation with themselves and say, what type of investor am I? They may want to be sort of in control and be based on fundamentals, which is something we advocate to give a little bit more certainty as much as you can in mining, versus the sort of reactionary trading sort of type of investment or indeed momentum followers. So Alan, in that vein, with regards to how do you feel? Because you spent a while chasing money down in the market when gold was, not fashionable. You also were beneficiary of when it came back in 2020, say 10 times gains there. Do you get slightly frustrated when you sort of see these sort of retread stories? Is it too much white noise? Does it distract from the real projects? What can we do about it?
Yeah, it's definitely a bit discouraging, Matt, particularly when you're knocking out the kind of drill results every week that we've been knocking out. And as I said at the outset, we've made 5 discoveries in the last 18 months on our project. That's on top of the 2 existing deposits, which are also growing at quite a clip. We got 5 rigs turning. So when the market sentiment is negative, it's hugely frustrating. The share price will go sideways. It won't react, even though you're drilling, 20, 30, 40 meters at 5-6 gram type of material. So I think investors, what they need to bear in mind here is when the gold price jumps up, there's always a time lag between, and there's a cascade from the gold price going up and then the majors moving up, then the mid-tier and the junior producers, and finally the exploration companies move up. And the exploration companies, even though they're higher risk, they're always last to move and they always make the biggest jump, right? And you haven't seen the junior explorers move yet. Most junior explorers are still trading despite this crisis, this geopolitical crisis, despite the outlook here that we're all pretty much agreed on, and the outlook for gold and the outlook for the global economy. The valuation of small little junior companies like ours have not moved. They barely moved. The median, if you can believe it, the median value for gold in the ground on resource median value is still about only $50 an ounce. And as you said, gold just hit 2,000 US dollars an ounce. That's how nutty, crazy the value disconnect is. What does that mean? A massive opportunity. Why? Because the juniors haven't reacted yet. And when they do, it's not a sort of a slow thing that happens over months. It happens over days. And then you're going to wish that you'd invested in quality companies. So, it's going to happen. I just don't know when, but it will happen. There'll be a value adjustment with companies like ours, and it'll be a significant one.
Okay, so that's quality companies. So what's the difference between a quality company and the rest? Because I need actionable advice from you guys. So what am I looking for, Alan?
Can I have a crack at that? I know I just answered the last question, but look, quality companies, if you're an investor looking to invest in this space, be it a junior miner or a development company like Danny and Kevin, a little bit more advanced than us or advanced explorer than us, look, your key criteria here, guys, are management. Are management invested in their company? Are they big shareholders? How much cash have they put in? What kind of salaries do they take? What other shareholders have they got in? Have they got quality? Have they done this before as a management team? Do they know how to get a deal done? Have they made money for their shareholders? What's the asset like? Are there ounces in the ground, or is this just a story? If there are ounces in the ground, how close is it to production? How big could it be? Has it got potential to go up double, triple? Has it got potential to be 10 times bigger than the existing resources? What's the jurisdiction? Those kind of things are really key things. But I think we'd probably all agree that the key thing is management. If management are heavily invested and have got a track record, then they're going to make that company a success. So anyway, that's my view.
I want to pick up on that as well, Matt, if you don't mind. I mean, I fully agree. I think there are so many rats and mice out there, and many of them are well marketed and drop a few names, but they really don't have a lot of tangible stuff behind them. Management is absolutely critical. If you intend to take a project through to construction and operation, you better have a team that's done it before in those places. In terms of the technical side, you have to be able to defend that. And I think with African Gold Group, one of the things we've really focused on very hard over the last couple of years that I've been involved is making sure that we can defend that. So if I say we've got 3.2 million ounces of resource in the ground and 1.25 million ounces of reserve, I better be able to defend that, which we can. And I fully agree with Alan as well. What is the upside? So are you investing in a company that has really hit its maximum? Is there no more in the ground that you're going to find? Is this a 10-year mine life, or is it a 20 or a 30-year mine life? And I think, I'm sitting here, I guess, as one of the minnows amongst the three of us, but we're sitting with a resource in the ground of $9 an ounce. We're sitting with a reserve in the ground of $20 an ounce. So even if you're looking at $50 an ounce, we're half that value at the moment, and we're fully permitted and we're ready to go. So yes, I think there's a lot of frustration from the juniors. I tend to agree with Alan that we will lag the market because the immediate producers, the big boys, will obviously take their profits very quickly on this high gold price. We lag behind that. But I think management and the fundamentals behind the project, in my opinion, are absolutely critical for investors in making sure that if you're going to put $1 into this company, it can be defended that there is the gold in the ground. It's a great project, and it will move. And I think that's what I've always advocated. And I've spent a lot of time in the last couple of years really focusing on the management and the technical side to make sure that we have what we say we have.
But Danny, yours is an interesting case, though. You've kind of come into a company where you've had to kind of clean up what went before, which you've done, all moved, reduce costs across the board. You've got a strong asset, and I believe all three of you have strong fundamentals. They are projects that are investable on a fundamentals basis. And for me, that makes me feel a little bit safer about my investing thesis going forward. But is it a case that maybe sometimes, Danny, if you can't beat them, you've got to join them, and perhaps this whole momentum play can, you need to change the narrative, you need to change the conversation in market, and how do you feel ethically if you were to do that?
Well, I think I'd feel a little bit better now because I can defend the technical and the track record in terms of management that's done it before. Whether I'm great at this sort of marketing game of really getting my company up there in front of investors, I guess maybe we've all got room for improvement there. But I think the other thing, Matt, that is interesting, and let's be honest. I mean, if 6 to 12 months ago, if you mentioned that you had a project in Mali, everybody would roll their eyes and go, "Oh, you're in the worst country in West Africa." Well, Mali has its challenges and has had its challenges, but so have many other West African countries. And really, when you look at Africa right now, it's not in the spotlight anymore because everybody's focusing across to sort of Eastern Europe. And there's been some pretty negative news coming out of countries in South America, thankfully not Brazil, but certainly Venezuela and Chile and Peru. So Africa suddenly become quite interesting again. And we have seen a huge pickup in interest in discussions that we're having around raising the finance to build this project, which 6 months ago we were struggling to get a meeting. And now all of a sudden, people are falling over themselves to speak to us. So I think there's a shift. I think Africa is actually probably one of the safe havens these days in terms of being a long way away from what's happening in Eastern Europe, and probably the least affected by it. Because if you have a look at the UN vote recently, a number of countries abstained. They didn't want to get involved. It tends to be an African thing. And I think that you're going to see a big pickup in Africa in investment in some of these projects, and certainly, hopefully, our project, but also, Mali over the past few years has maintained its position as the third largest gold producer in Africa, and with a very stable mining code and a very stable output. So I think we're seeing a shift. I think we're seeing a lot more interest in projects in parts of West Africa that maybe 6 to 12 months ago were not as interesting. And I think we're sort of hitting this at the right time from the position that we're in terms of going out to raise the money to build this thing.
I'd like to just step back to the question before, Matt, if you don't mind. I was listening to Alan and Danny agreeing with each other that definitely management is key, and absolutely management is key. I don't think you will have anybody on this call that will dispute that. And if you do on another call, you shouldn't be having them on. Management is key in moving things forward. You can have a decent project that poor management can fumble, but you can have very good management that makes a decent project look really good and work out really well. And the fundamentals behind it are extremely important, as Danny said, and also jurisdiction. So when I was listening to Alan and Danny, I was thinking about ourselves, and I was thinking, okay, we ticked every box that was mentioned. Are there ounces in the ground? Yeah, 3.1 million. Are there reserves? Yeah, 1.1 million. Is the grade good? Yes, fantastic. What's the jurisdiction? Eastern Canada. Has management done this before? Yeah, about 7 times. I've been involved in 7 builds. We've done this. And, when I joined almost 3 years ago, we had 1.3 million ounces and a 30 million market cap. We now have 120 million market cap, 3.1 million ounces, of which 1.1 million are reserves. So, the value of our feasibility is showing a $330 million value discounted at 5%. That's just for our open pits. We feel the same is going to happen, another 300 or so million value for underground, as the PEA suggested. So we can see us going up 400% again in a regularized gold environment. But with gold, the bull market that we're seeing now and the volatility that we're seeing now, Alan, hit it right on the head with this delay in juniors, because we are last. And we will, all 3 companies here that you're talking to will go up significantly in value. And I, like Alan, don't know when, but it will happen. And because I think that way, I have put my entire salary, my bonus, and more back into the company, buying along shareholders. I'm not a founder. And I've built my position up in the one company that I truly believe in and trust management. And that's my own. So I think, with that said, I think all 3 companies here are going to do extremely well. But it will take time. And then it will be, like Alan said, it'll go up sharply. I'm Canadian. I'll say it'll go up like a hockey stick. So, there's really sharp rise, and everybody will say, why didn't you tell me about your company? I missed it. Well, we've been telling you for 3 years. You just don't listen in the hard times. So people need to get in and own some of these juniors that have quality management and proper fundamentals.
Here's a question for you with regard to funding for you guys, right? Where some companies have been extremely creative. We've heard some fantastically creative scenarios about how they stop dilution for their shareholders. Retail love to hear when management can find a new funky way of doing that. Do you think with gold prices moving like they are, that's only going to be available to developers? Or do you think that juniors too will ultimately be the beneficiary of some of this cheaper, less dilutive capital? Maybe Alan, do you want to pick that up?
Yeah, I think, there will be more financing alternatives as the investor appetite picks up for junior companies. There will be. So there'll be more royalty companies that want to do deals. There'll be more people offering debt. I think if you've got no revenues, it's almost suicide to take on any debt. But the cost of capital is going to get cheaper because share prices are going up. So instead of raising money at 50 cents, we may be raising, like Kevin said, money at $1, $2. So the dilution is going to decrease. It is something that is very, very foremost in all of our minds, I think, is when we need to raise money, at what kind of cost, how much dilution we're going to suffer. And I think if you're the largest shareholder in your company like I am, and you got $1.7 million of your own money at stake, which I do, that's how much I've put into this company so far. And so, you're aligned with your shareholders and it looms very large, Matt. But I do think there are always people coming out with new ideas of financing the company. Personally, I run a mile if I start to see something which is a bit hokey, and we all have. There's all people, sort of strange, odd variants about how you can minimize your dilution to your company, because that is the trick. You want to be raising as much money as you can at high prices. So we're all very cognizant of what's going on in the marketplace here. But personally, some of these sort of like unusual forms of financing, I steer well away from.
I think traditional debt in these things sometimes are required for those dilution purposes. I'm not talking about streaming your only revenue product or putting royalties or anything like that. But traditional debt, if you've got it, are linked to a number of things in a project. One of them is the delta, but one of them is the jurisdiction. And we have been blessed with finding a high-grade deposit in Eastern Canada in a great jurisdiction. And that takes a few points off the cost of capital. So and also we're very, very conscious of dilution, so much so that we've been operating and selling between 15 and 20,000 ounces of gold for the last 10 years out of Newfoundland from a small operation that people have said, it's little of your value and takes a lot of management time. But we've leveraged that and changed the story from being just this small producer to having a cash engine that is non-dilutive to the company to advance Goldboro to where it's at. We have been to the market twice for hard dollars in 10 years. And we've moved Goldboro forward to 3 million ounces and a feasibility study without issuing shares. So we're conscious of dilution, but at some point, there's a mix between equity and debt. I would prefer higher equity than debt. I think I'm like Alan, and I don't think there's many of us out there, to be quite honest. I think a lot of people like these funky deals, but I would rather have a very simple deal that isn't handcuffing the project moving forward. And I think being in the proper jurisdiction. And by the way, I worked in West Africa for years and years, and I think it's one of the best places in the world to work. Sometimes perception's 9/10 of the law, and people perceive it as being difficult. When Mali I love Mali's excellent place to work.
Well, Dan, that's a nice compliment, Danny.
I appreciate it. Yeah, I agree.
Well, let me ask the question for you, Danny, because the guys have talked about their preferences. For you, though, it's a strange situation. You're a sort of $30 million, sub $30 million company with a DFS with a lot of gold in the ground at these prices. You absolutely can't afford to go the equity route without diluting the heck out of all the shareholders. So you've got to look at alternative financing, don't you?
Yeah, so maybe let's split that, Matt. I mean, I think for money to explore and to keep the lights on, I absolutely agree that these very strange types of financings, like convertibles and even the royalty streams at an early stage, are not the best way to go. It's always preferable to not dilute your equity holders at a lower price. So what we've obviously done over the last year or so is cut massive amounts out of our costs to keep ourselves very lean and mean. That really sort of inhibits a cash drain on the company, and it allows us to raise very little to keep ourselves going. But let's talk about the main financing. I think there's no doubt about the fact that the main financing, we will ultimately have a split of debt and equity. These things are always going to be done in parallel, because the debt guys don't want to do anything unless the equity guys are on board. The equity guys clearly right now are not going to get completely diluted out of this thing. So these discussions are happening in parallel. But as I've said, I think we've had a situation, especially with some of the African banks, who have not really financed much in the last couple of years because of COVID and because of sort of tightening their net and just keeping their heads down and seeing what's going to happen. So prior to what happened 2 weeks ago in Ukraine, we were seeing already quite a lot of activity from a lot of the traditional banks that finance African projects coming back online. And even though in the last 2 weeks it's been pretty volatile and no one really knows what's happening, those discussions have carried on. So I think that there will be, I think our best mix of financing to raise the money to build this project will be probably 60-40 debt equity or 70-30 debt equity, very vanilla debt in the sense that it's mostly coming from a sort of a large banking institution, not too much mezzanine or strange stuff that can happen. And definitely, as Alan said, a much lower cost of capital than probably would have happened 2 years ago. And then with the equity stream coming along and backing that up. And I think that re-rate happens very, very typically in companies of our size when you start to get the first chunks of financing approved. A company at our market cap with a fantastic project, which it is, in a jurisdiction that we're very comfortable with, and a great project with lots of ounces in the ground. The simple question that everybody's asking is, okay, great. So how are you going to raise the 180 million that you need to build this thing? And that's that's what's depressing our share price right now. And I think what we need to do is get a couple of wins on the board, which I think we will do this year, pending the world doesn't sort of dissolve. And then I think we'll come out of this looking pretty strong in the second half of 2022.
Let me come back to you in a couple of minutes.
Matt,
yes, okay.
Can I just qualify my comments? So I think Danny and Kevin are absolutely right. And if you're an investor watching this, you should be, debt is okay if you've got a project which is at feasibility, is at the build stage. It's not okay if you're considering looking at a company that's exploring and still drilling, adding ounces. Don't invest in a company that's taking debt on, because that company's too far off production. There's no certainty of production. So, just bear that in mind. It really does depend on where you're at with the stage of your project.
Worth clearing up. I mean, Danny, so I want to come back to something you said, because I want to learn from this session, okay? I'm always learning. Is you said that you would be adverse to converts or NSRs at this stage, or in the position that your company finds you in. Explain why. So if I come across a situation like this, at least I've got some other factors to think about before I make a decision.
Well, I think... let me qualify. I think that an NSR or some form of stream will potentially form part of a financing package. But there are so many royalty companies out there right now that will offer equity and streams for exploration companies, and it really goes back to what Alan is saying, where effectively you're lumbering yourself with debt with no sort of runway through to when revenue is going to come in. And the worst thing you can do with debt is to have debt not knowing when that revenue is going to come in, because at some stage someone's going to call for that debt back.
Danny, I think also with certain forms of these financing packages, they come with basically the box around your upside as well, and that you never want to give away your upside at this stage of the game.
it's almost always linked to upside, and that is what the risk that they're taking. I mean, if you think you've got a 20-year mine life and you're saying you've got a 10 or a 15, you lumbered for 20 years. So I think you're right. So yeah, look, I think it could form a part of it. And the nice thing about the royalty side right now is there are so many royalty companies that the competition out there is pretty amazing. I mean, you're seeing some really innovative sort of structures that could be of interest, that are very different to the, what shall I call it, the typical old-fashioned royalty companies.
The competition has really increased, and that forms some new ways of thinking from their end. Because I spent 2 years of my life a certain lifetime ago trying to get rid of a stream that was handcuffing the project, but we're going to keep an open mind. We're smart enough to hire a financial advisor to go into this debt equity or project finance discussions and do it right, and keep our minds open to all ideas and really evaluate them. Because the time to get permits is always longer than shareholders want, but that gives you the time to get the proper finance package together.
Actually, I think Kevin, you hit the nail on the head there. And Matt, this is maybe something that we certainly haven't discussed in the last couple of months, but what I think we've realized is that there are expert companies out there that can structure the financing much better than we can. We're operators. We build things. We operate things. We build teams. And I think that what you're going to see with African Gold Group over the next couple of months is a much more structured approach to this from people that have done it many, many times before. So effectively, what we're doing is we're bringing an extension of our team on that are experts in raising the money that we require to move into the next phase of our life cycle. And I think, maybe it's taken a little bit of time to realize that, but I think that in reality, the cost of doing that versus the rewards are significantly lower. And from us, if you're looking at PNAV at 0.11, I think we are at the moment. If you're looking at like I've mentioned before, the resources in the ground and the reserves in the ground, there's only one way that we can go, and that's up. So the quicker we can get a re-rate based upon securing the financing that will allow us to build this thing, the better it's going to be for all of our shareholders. And like Alan and Kevin, I've put a lot of my money back into this in stock. I'm also not a founder of this, so I came in quite late in the process, but built up a reasonable shareholding because I really do believe in this company.
Well, look, gentlemen, I think we better wrap it up. And Danny, I'd say you better follow your own advice with regards to who you choose to get help with the financing. It's all about the management team and their track record. Gentlemen, look, thank you very much for your time today. It's kind of given us kind of food for thought about maybe how we should think about investing in companies. So Kevin Bullock of Anaconda Mining, Alan Carter of Cabral Gold, and Danny Callow of African Gold Group. I thank you very much. We'll see you soon.
Thank you.
Thank you.
Thanks, Matt. Good to chat. Thanks, gents.